Okay, welcome here to what we are going to be looking at is Chapter 2 material in the Wygant text of Financial Accounting. It's of the Wiley series. This is actually what we cover in part for week 1 here at Ivy Tech. This is what you see here is the fundamental accounting equation. For Accounting 101 and any like Accounting 201 and on as you go into intermediate, you have to have this equation memorized. This equation we're going to use throughout the rest of the semester in this class of financial accounting. And so the assets, this is an actual equation where the left side, the assets, have to equal liabilities plus owner's equity plus revenue minus expenses. Okay, so like if this side, for example, went up $10, the side over here would have to go up $10 somewhere. It could go up 5 here and then 10 more here, but then subtract out another 5 in the expenses to get 10. So no matter what happens, both sides have to equal, just like in any math class. So not only do we need to have this equation memorized in accounting, we also have to have the normal balances memorized. Normal balance means simply where is the plus side on a T account. These are considered T accounts because I know my little drawings don't quite look like a T, but they're pretty close. They look like a small T, and everything that happens in accounting is going to go either on the plus side or the minus side of some type of account. I call this, the 5 things up here, I call these the parent accounts, because everything that happens in accounting is going to go underneath one of these 5 parent accounts. Now, underneath each one of these 5 is a whole bunch of individual, more specific accounts. For example, under the assets, we have things like cash and equipment, whereas under liabilities, we have things that we owe, like accounts payable. We're going to go through those in just a few minutes, what each some of those are. But one of the things you have got to memorize, somehow write this down in your notes, is that this side, the assets, and the very other side, the expenses, they look the same. They have plus minus, plus minus. Everything in the middle is minus plus. It's something you have to have memorized for this course. Another couple terms that we definitely need to have memorized in this course is what exactly a debit and a credit mean. A debit does not mean what you think it might from banking experience. Debit simply means left, the left side of a T account. So therefore, debit does not always mean plus or always mean minus. It can mean either. For example, as an asset, if we debit any type of an asset, we're going to have a plus. Whereas if we debit a liability or maybe an owner's equity account, it's going to be a minus. So that's one of a big hurdle for quite a few students is to get past that debit always means one thing, and it doesn't. Credit is the same thing. Credit does not always mean minus or plus. It could mean either. As an asset, a credit takes away an asset. But a credit to a liability account actually increases your liabilities. Now, a couple things that I wanted to do is just briefly explain what these accounts are, what these parent accounts are, and then some examples of specific accounts underneath each. So as I look down here, an asset, any type of assets generally meet one of these 2 criteria. It's generally something that you own. A lot of times you can touch it, or you have the rights to that item, or you have the rights to own it. Let me give you a couple examples of some assets. A couple assets here are some of the more common ones that we'll see. And you'll notice that there's numberings along with these as well. But let's look at the actual accounts first. Cash, of course, that if you have it, we're going to assume that you actually are entitled to it and own it. The next thing, and these all go in order of liquidity. So liquidity means how fast can something be turned into cash, or are you going to get the use of it? This AR, that stands for accounts receivable. And I emphasize receivable because we're going to have an accounts payable here in just a few minutes. That's just the opposite. But accounts receivable is something that I plan on receiving in the near future, cash. So generally, I've done something for somebody, and they just haven't paid me yet. And that would be an account receivable. And since I plan on getting this money in the near future, it's almost as good as cash. And so that's why it's the next one down in order of liquidity. We're always going to keep our assets in this order. Next, we have prepaid accounts. I'll talk more about this. I'm going to skip over this for now, and we'll come back to this once we look at the expenses, and I think it'll make more sense. Next down, we have inventory and/or I'm going to put supplies. Oops. Inventory and/or supplies. It could be either or both. What this means is generally we have it like inventory, and depending on how fast these items turn over and we can sell it, we will have cash, but it could be a little ways out before we actually get the money for that inventory. Supplies, usually we're not going to get the money for it, but we will get a benefit out of it. And then the last items, everything that we've looked at so far are considered current assets. And these are items that usually change at least once, but usually multiple times throughout a year. Everything down below supplies and inventory are considered non-current assets. And these generally go in the category of PPE, which stands for property, plant, and equipment. Property is your land if you own any land. Plant would be a building. And then equipment is everything else that your business owns that you're going to be keeping for a long time. So those are property, plant, and equipment, things you don't plan on selling and would be hard to get cash right away if you needed it. So that's why they're long-term. The next item on our parent accounts, we just looked at the assets, is our liabilities. Liabilities, usually you think of those as debts, and it's something that the company owes. It doesn't always have to be money, but a lot of times it is. And we will look at one item in particular that's not money that you can owe as a business. So let's pull back up our list of accounts, and I'm going to add one in here. But the first two are our very typical ongoing accounts that we have with some of our vendors that supply to us quite often. And these are called accounts payable. And notice it's very similar to accounts receivable, but these are accounts payable. We owe somebody money. We're going to be paying them money. And how I like to do it is I like for each one of these, for either an account payable or receivable, I like to have a specific account for each one of them. So if I have an account payable to Sears, I want to know exactly what I owe Sears and not just what do I owe in general to all of my vendors. I want to know exactly who I owe and what. Our next category here, WP, stands for wages payable. So that's when our workers have done work, but we will pay them in the near future. Our next one is unearned revenue. And let's say I call this account 215. Doesn't have to be 215. Note that each chart of account numbers are items that the company makes up. I could have made it 220 and made no payables 250, but just as long as they go in this order of most current to most long-term. Unearned revenue is, as you'll see in just a few minutes when we talk about revenue, these are something that I've been paid for in advance, but I just haven't done the work yet. And a real good example of an unearned revenue is gift cards. Gift cards would be a very good example. If you would go to a restaurant and purchase a $20 gift card, they haven't provided you a service, but that gift card tells them that you've already paid for it, and then when you go ahead and redeem it, then they can report it as revenue because the service has been provided. Finally, we have NP, which stands for notes payable. These are our long-term items, long-term debt. Generally, these would be like a mortgage, a car loan, student loans could be a note payable because they a lot of times involve or generally will involve interest and then payments out beyond a year. So that's the main difference between an account payable, which are things that are generally due within just a couple of months, if not less, and and then a note payable, which is out over years usually. Owner's equity. Owner's equity is simply what does the owner have invested into the business, and then we also use owner's equity to show what the owner has taken out of the business. We call that a dividend. Let's look at some of the accounts. So this will kind of help explain it. This first one, capital, and Wiley Plus calls it common stock. And these terms are synonymous. We can use either one. We don't have to put the owner's name next to it, but you can if you have more than one owner. But capital and or common stock, they mean the same thing. And this account simply shows what the owner has invested into the business. The owner needs to be able to keep track of that. And dividend, or I'm going to put this first, drawing. Dividend or drawings. This is what the owner has taken out. Just like if you were a stockholder in a corporation, you receive dividends for your investment. That's the corporation paying you, the owner. Same thing as if you're a sole proprietor. If you pay yourself, it's considered a drawing account. And that's going to actually reduce your owner's equity. We'll talk more about that in a minute. But one of the key things about drawing and dividends is this is a contra account. And contra accounts mean they have a opposite minus plus. Or, in this case, remember owner's equity accounts have the minus plus back up in our T accounts. Well, since this is considered a contra account, this one actually has a plus minus. And there's just a few of these scattered throughout that we'll see throughout the semester. You just have to memorize which ones are which. This is the first one. So we're going to keep that in the back of our head, that this is a contra account. Finally, the last main item that we're going to find in owner's equity, there are others, but these are the main three, is the retained earnings. And retained earnings is simply how much has the business earned throughout its entire existence. Every year, hopefully, the business will have earned money. And this account, this retained earnings, is simply an accumulation of all of those earnings put together. And if you think about it, it's part of the owner's worth. If the owner has saved money each year, that belongs to the owner. So that's why it's there in the owner's equity. Our fourth item in our of our equation is our revenue accounts. And these can be called different things. Service revenue, if you're an accounting company, you're going to be providing services. So you would call this service revenue. If you're in the business of actually selling goods, then you're going to call it sales revenue. It's the same thing, we just call it a little something different. Another term that sometimes Wiley Plus will use is fees earned. So we could have fees earned. If you're in the rent business, you might have rent revenue. So we just use the different terminology for what type of revenue it is. Now, GAAP says there are two criteria that must be met in order for us to count something as revenue. And we just want to have and have memorized for this class. Basically, the first one here is pretty self-explanatory. The company has to be paid or have a promise to be paid. And remember back to what a promise to be paid was. That was something that we have the rights to own as an asset. That's considered an accounts receivable. So we're going to be receiving the money. Somebody has told us they will pay us in the near future. And the second criteria is the job was completed. So once we have done the job and we've been paid or promised to be paid, we can count our actions as revenue. Now, to kind of give you what could not be considered revenue. Basically, this one says if I just went and shoveled somebody's driveway out of the blue and they never asked me to and didn't tell me they would pay me, I can't really count that as revenue. I probably won't be paid. And just the opposite here, if somebody pays me money but I haven't done the work yet, remember back up to liabilities, that's called an unearned revenue. So if I haven't met this criteria where the job's complete, like with the gift certificate, I haven't actually provided them the food yet in the food business, then I can't call it revenue. I have to call it unearned revenue. The chart of accounts is pretty simple on that one. It's just whatever type of revenue we're going to use. So we usually will just have one or two accounts. As we get later in the semester, there will be more that we'll add in. Finally, our last parent account is the expenses. Expenses generally will meet two criteria. So for something to be an expense, usually the business will get the benefit of something. For example, wages. The business got the benefit of having workers work for us and doing jobs, whatever it is. Advertising. Somebody has provided word of mouth for our business. We've got the benefit of something. Rent, insurance. There's lots of different things that can go into the expense category. And the two questions for us to know if something is an expense is, and these are things that I've kind of made up. It's not necessarily found in any book. But is the company receiving a benefit now, like with rent? If I pay for rent and I'm in December and it's actually December, then I can call that a rent expense because I'm using it now. And the other criteria is that rent that I'm using right now is definitely not going to last me more than a year. It's only going to last me a month. So that would meet the two criteria if I paid rent for right now. However, if I paid for rent for the next 2 months as well, I paid it for January and February. Well, for those 2 months, I'm not receiving a benefit yet. I'm going to be receiving a benefit in the future. I have the rights to that benefit in the future. And if you remember back up here, if there's an asset and we have the rights to own it, well, it's considered, in this case, prepaid rent. And we could have a prepaid account for about any type of the expenses. Some expenses aren't going to make sense to have a prepaid account, but a lot of them it does. Prepaid rent would be a great example. Prepaid insurance would be another one. Basically, I'm paying for rent that I'm not using right now because it's in the future. I don't want to call something an expense that's not happening this year. Because I want to say if I'm in the year 2016 in the books for 2016, I don't want to have an expense for 2017 show up in this year's. It's going to make my net income be off. However, an example of this one where it may not come true is if I bought a piece of a large equipment. Now that large equipment, I'd probably be receiving the benefit of it now. But with something large, I'm probably going to be receiving the benefit of it for more than a year. So therefore, I would not meet criteria 2 with equipment. And therefore, it goes back to the assets. So generally, if it doesn't go here in the expense, it's going to go up to the assets, just like with the prepaid accounts. I've already briefly talked about the chart of accounts. Remember, those are the numbers that go along with each account, just kind of like an ordering or a cataloging of each account. So if I say account 100, you'll know that it's cash. In our next video, I'm going to begin to look at some actual transactions. And with every transaction that happens in a business, there must be these two items that occur with it. You're going to have a journal entry, and you're going to have a T account, the T accounts that are updated. T accounts are also known as a general ledger. General ledger is usually the more fancy term. T accounts are more of on a scrap sheet sometimes. But basically what they do is they give you, I can easily look at my cash account, for example, and know exactly what my cash is at any one time. And the journal entries, they help keep things in nice, neat order. So if I want to know exactly what happened on December 5th, I can easily go back into my journal and look at all the journal entries for December 5th and get a good idea of what happened. As we do journal entries, you're going to find a couple things. Debits always go first in a journal, and credits are always going second, and they are indented. It's kind of like a paragraph gets indented. When we're doing journal entries, I would highly recommend using journal paper. You can find some samples of journal paper online, or if you just want to buy hard copies, you can easily find them at Walmart. I know they have them at Walmart, and at most school bookstores they have them as well. At Walmart, the last time I was there, I think I saw it for $3.88 or thereabouts. So the journal paper, it's usually a greenish color. I don't have my book with me, or else I would put one up for you to see. The T accounts, I'm going to have, hopefully you'll have examples of these, but I will try to make these available to every one of my classes and any of the other Accounting 101 classes. You should have an example of a T account sheet. If you don't, you can always let me know, or your instructor, and I can get that for you, get a copy of it. I'm going to bring up my T account sheet in just a minute for you to have an idea of what I mean right after we go through these last couple of questions. So these last couple of questions, when we do start getting into looking at business transactions, we're going to always ask ourselves these two questions. These two questions you're not going to really find in a book anywhere. It's two things that I've made up, and these questions usually help out in knowing what accounts get used for each individual transaction. We're going to always ask ourselves this first debit question, because remember, debits always go first. What did the business get? Now, the business could have gotten a lot of things. They could have gotten money. They could have gotten equipment. They could have even gotten a reduction of debt. That's one of the things a business can get. If they pay money, they can get a reduction of their debt. They may have gotten the use of advertising. Those are all examples of things that a business can get and would be a debit account. The credit account then, let's say we got advertising, is how did I get the advertising? What did I have to do to get advertising? And most of the time it's going to be because you paid cash. And so we would credit our cash account. Another example would be maybe I got equipment. And how did I get it? I got it on account. I'm going to pay that store later. And so therefore I'm going to put it as an accounts payable. When we're all done, I always want to make sure that I have at least one debit and one credit. And did the transaction equal? Now, to finish out this video for this week one, before we get into the examples, I did want to go ahead and show a couple my T account sheet. So I'm going to quickly bring this up. And here we go. When I say a T account sheet, this is what I'm talking about. And this is my help example for T account sheet. When we actually do homework, a quiz, test, I'm not going to be the ones that you're given to. You won't have this helpful plus minus system already on here. So remember the two N's, expenses and assets, they have the plus minus. Everything in the middle has minus plus. Easy way to remember that. And then a couple other things. So I have some specific accounts, and these are just accounts that are common. You're going to be able to have the opportunity to change these at any point or add to them. For example, here I have prepaid rent. But if in your example there is no prepaid rent, call this something else. Call this prepaid insurance. For this one, if you're using supplies in your company and not really inventory, call it supplies. Vice versa, if you're using inventory, use inventory. So there's my long-term assets, equipment. Another piece of equipment down below. So every time we have a piece of equipment, we're going to call it, we're going to have a new T account. Cash is always the biggest one because cash gets used quite a bit. And then you'll notice where I have gray squares and I have a big no. Whenever we have a cash transaction, our very first entry should never ever be a credit to cash. Simply because that would be a negative to cash. I can't have my first entry be a minus to cash if I don't have any cash to even pay out. I can't pay out cash that I don't have. Same for any of the other items. Anywhere, for any account, your first entry cannot be a negative. Like for here, I can't owe somebody a negative amount of money. That's just weird. But notice here, the no is only on the first category. Once I have some money, once I got some money from whatever source, say it was $1,000, then I can start spending it, and it's likely to happen. And then I maybe get more money later on. However, what's not the case is for our two ending items, revenue and expenses, we're almost never ever going to have a debit to a revenue account. There's one exception, and that's only really if you make a mistake and you have to go back and do a correction. So almost always we're never ever going to debit our revenues. We're always going to credit revenues. And the same for expenses. We're always going to debit our expenses. It doesn't really make sense to have a negative expense. You're getting a negative amount of help or transaction for your business. It's always going to be on the positive, a benefit to the business. So this is what I'm going to be referring back to as we do examples here. in our next video. So hopefully you have gotten something out of this. If you have, please let me know in the comments. It really helps me to continue to make these. I appreciate it.